If you spent any time at all scrolling through the news, or really any financial commentary this past weekend, you were almost certainly told to panic.
Oh, absolutely. The noise was deafening.
Right. It's Monday, March 2nd, 2026. And based on the geopolitical shockwaves coming out of the Middle East, I mean, the prevailing narrative was that you needed to brace for a historic market crash the absolute second the opening bell rang today.
And it's understandable why people thought that.
Exactly. We had severe escalations, U.S. and Israeli airstrikes on Iran, warnings of a prolonged campaign. So if you were looking at your portfolio on Sunday night, you were likely mentally preparing yourself to see an absolute sea of red.
Yeah, the setup was incredibly tense.
But we have the final numbers for Monday, and looking at the tape, we just witnessed a massive market head fake. The S&P 500 erased a 1.2% intraday drop to finish perfectly flat, and the tech-heavy Nasdaq actually closed in the green.
Which is a brilliant setup for what we're doing today, because the contrast between those weekend headlines and the actual reality of Monday's trading session, it is just a fascinating study in market mechanics.
Yeah, so our mission for this deep dive is to cut right through that initial wave of fear. We have a massive stack of sources today: live Bloomberg terminal data, Yahoo Finance intraday charts, direct quotes from tech CEOs, Wall Street analysts.
All of it.
Right, all of it. We're going to unpack the ultimate lesson in not panicking. We'll look at how the financial system actually absorbed this shock, why energy and crypto are seeing such intense volatility right now, and we are going to break down some truly ruthless corporate pivots in the tech and defense sectors. Things that are reshaping the landscape while everyone else is just staring at the broader indices.
It really is a masterclass in watching what the big money does rather than what the headlines say.
So let's start with the catalyst, because I want to play the skeptic here for a minute. Over the weekend, the news was undeniably serious. We saw U.S. and Israeli airstrikes on Iran. This resulted in the death of Supreme Leader Ayatollah Ali Khamenei, along with other senior officials. Right. We also saw statements from the Trump administration warning that this campaign could last for weeks. When you combine that level of geopolitical upheaval with an economy that's already a bit jittery, I mean, the script seems like it writes itself. Why didn't the bottom fall out today?
Well, it's a completely logical question. And to be fair to the panic, the market did actually reflect that fear right out of the gate.
It gapped down immediately.
Exactly. When you have a sudden escalation involving a major oil-producing nation, the immediate reaction of both human traders and the algorithmic bots is to shed risk. At the opening bell, the S&P 500 immediately dropped. It fell as much as 1.2% in early trading.
Right. Sectors like consumer discretionary and financials took a hit instantly.
They did. But the real story of Monday isn't the open, it's the close. By the end of the day, the S&P 500 rose 2.74 points from its open. That is a gain of 0.04%, closing at 6,881.62.
Basically perfectly flat.
Perfectly flat. And the Dow Jones Industrial Average fell only 0.15%. The Nasdaq Composite actually rose 0.36%, and the Russell 2000, which tracks smaller domestic companies that index, jumped 0.9%.
See, that is the part that feels entirely disconnected from reality. We have an active military conflict escalating, and the Russell 2000 is up almost a full percent.
It seems counterintuitive.
It really does. So help me understand the psychology of that trading day, especially through the lens of the VIX. I know the SIBO Volatility Index spiked over 21 this morning, which was an almost 8% jump. For someone listening who doesn't look at options pricing every single day, what is the VIX actually measuring in a moment of panic like that?
Sure. So the VIX is colloquially called the market's fear gauge, but that term can be a bit misleading. Mechanically, it is a measure of implied volatility. Think of it like a fire insurance premium on your house. It tracks how much investors are willing to pay for options contracts to protect their portfolios against a sudden drop in the S&P 500 over the next 30 days.
So when the news hit over the weekend, everyone rushed to buy that insurance.
Exactly. Institutional hedging demand skyrocketed. Every fund manager rushed to buy protection simultaneously. And that massive surge in demand drove the price of that insurance straight up. That's what we saw when the VIX crossed that key psychological threshold of 20, peaking at 21.44 this morning.
Because everyone genuinely thinks the house is about to catch fire.
Right. But then the trading day goes on, and the house doesn't burn down.
The systemic crash just didn't materialize.
No, it didn't. Implied volatility is just an expectation of future movement. When the market opened, absorbed that initial wave of panic selling, and then failed to break lower, the fear began to subside. Traders looked at the tape and realized the crash wasn't happening today.
So the premium on that insurance evaporated.
Precisely. The market, stabilizing by the close, effectively crushed that implied volatility. In options trading, they call this an Ivy crush.
Which means if you let the weekend headlines dictate your strategy and you sold everything right at the open, you essentially paid the absolute maximum price for fear right before the market turned around.
You got shaken out at the exact wrong moment.
But is this kind of resilience normal? It just feels like the equities market is almost ignoring a war?
It's not ignoring it. It is coldly calculating the long-term impact on corporate cash flows. We have a great note in our sources from Morgan Stanley strategists led by Mike Wilson who addressed this exact phenomenon.
What did they say?
They pointed out that historically, geopolitical risk events simply haven't resulted in sustained volatility or prolonged drops for U.S. equities. Unless a geopolitical event fundamentally and permanently alters global corporate earnings, the initial shock usually fades really fast.
I suppose if you look back at historical shocks of the Gulf War, the early days of the Ukraine conflict, the initial plunge is rarely the start of a multi-year bear market, unless there's already some underlying economic rot.
That is the historical precedent. The market digests the new reality, prices the risk into the directly relevant sectors, and then the broader indices just move on. And this ties directly into some really fascinating seasonality data we have from Yahoo Finance's Jared Blicker.
The 1928 stat, right?
Yes. He highlighted that the S&P 500 has had the smallest trading range to start a year since 1928. It has been incredibly constrained, bouncing strictly between 6,800 and 7,000.
Since 1928. So for nearly a century, we haven't seen the market this tightly bound in the first quarter of the year. What does that tight channel actually tell us about the underlying strength of the market?
It indicates a profound equilibrium between buyers and sellers. When a market is bounded by such a tight historical channel, it takes a massive systemic economic shift to break it out of that range. Even with a major military escalation over the weekend, the S&P 500 gacked down, tested that 6,800 support level for the fourth time this year, and just bounced right back off it.
The buyers stepped in precisely where they have stepped in all year.
Exactly. So for you listening to this deep dive, the takeaway here is clear. The data usually overrides the emotion. Looking at where the technical support lies and watching how institutional capital actually behaves is far more instructive than reacting to a breaking news alert.
That makes sense for the broader equities market. The S&P 500 can stay calm because most of those companies aren't directly impacted by what's happening overseas. But let's shift to a sector that absolutely is impacted. Because while the stock market was putting on a clinic in remaining calm, the commodities market was thrown into absolute chaos today.
It was a very different story there.
Let's talk about the geopolitical pivot into the energy shock. Oil went on a massive tear today. Brent crude, the international benchmark, jumped 8 to 9%. Hitting nearly $79 a barrel.
A huge move.
Huge. And West Texas Intermediate, the U.S. benchmark, surged over 7% to around $72. And this isn't just an abstract Wall Street metric. If you were going to the gas station this week, you are going to feel this. The national average for gasoline at the pump is rising rapidly, sitting just under $3 a gallon, and the trajectory is pointing sharply upward.
This is where the geopolitical reality intersects directly with the physical limitations of the global supply chain. The underlying reason for this violent spike in energy prices is entirely rooted in geography, specifically the Strait of Hormuz.
Right. According to the reports in our sources, Iran closed this critical choke point. We hear about the Strait of Hormuz every time there is tension in the Middle East. Let's really unpack why this specific body of water has such a disproportionate grip on the global economy. Why can't ships just take a different route?
To put the geography into perspective, the Strait of Hormuz is a narrow waterway between the Persian Gulf and the Gulf of Oman. At its narrowest point, it is only about 21 miles wide. And the actual shipping lanes that are deep enough for these massive supertankers, those are only 2 miles wide in either direction.
Wow, just 2 miles.
Yes. There is simply no viable way around it for the volume of oil we are talking about. Roughly 20% of the world's total oil flows pass through this single choke point. It is literally the jugular vein of the global energy market.
So when you have reports that the strait is closed and that tanker traffic has come to a standstill, the market has to immediately price in the possibility that 1/5 of the world's oil supply is suddenly offline.
And it's not just the physical blockade of the ships, it's the financial blockade of maritime insurance.
Right, the war risk premiums.
Exactly. When tensions rise in a region like that, maritime insurers start denying war risk coverage. Or they price a premium so astronomically high that it becomes economically unviable for a shipping company to send a tanker through. Even if a ship could theoretically slip through the strait, they won't risk a $100 million vessel and its cargo without insurance.
The insurance market reacts faster than the physical ships do.
Precisely. And the disruption today wasn't limited to oil. The natural gas market experienced an equally dramatic shock. European natural gas, specifically the TTF futures, soared 45% intraday.
Let's pause on that. 45% in a single day for a major global commodity is staggering. For our listeners who might not trade energy markets, what exactly are TTF futures and what triggered a spike of that magnitude?
TTF stands for Tidal Transfer Facility. It's a virtual trading point for natural gas in the Netherlands, and it serves as the leading pricing benchmark for the entire European gas market. A 45% jump in the TTF means that the expected cost of energy for European manufacturing, heating, and electricity generation just nearly doubled in a matter of hours.
And the trigger for this specific surge was a direct attack on infrastructure, right?
Yes. Qatar Energy, which is one of the largest liquefied natural gas producers on the planet, halted operations after their facilities were struck by drones. Because Europe has heavily relied on LNG imports to replace Russian pipeline gas over the last few years, any disruption to a major supplier like Qatar sends immediate shockwaves through the European energy benchmark.
So we have oil surging because a critical shipping lane is closed, and natural gas soaring because physical production facilities are being struck by drones. This brings up a critical macroeconomic problem. We have spent the last 2 years talking about the Federal Reserve fighting inflation. If energy prices go parabolic again, that fight gets incredibly complicated.
It changes the entire narrative.
Which brings us to a quote from Jamie Dimon, the CEO of JP Chase. He gave an interview at a leveraged finance conference in Miami today, and he used a very specific phrase. He warned that higher inflation risks being the skunk at a party for the U.S. economy.
Dimon has a talent for colorful analogies, but the underlying warning here is severe. Let's look at the context. The January Consumer Price Index numbers were fairly mild, rising just 0.2%. That mild reading created a very comforting narrative in the markets that the Federal Reserve had successfully engineered a soft landing, that they had cooled inflation, and that steady interest rate cuts were on the horizon for the rest of the year.
The party Dimon is referring to is that optimistic economic consensus.
Exactly. And the skunk is the sudden realization that everything we buy, everything we consume is transported using oil. If oil stays at 80 or 90 or $100 a barrel, that soft landing narrative goes completely out the window.
JP Morgan analysts actually warned today that if passage through the Strait of Hormuz is restricted for just 3 to 4 weeks, it could drive Brent crude prices above $100 a barrel.
And if oil hits $100 a barrel, the cost of manufacturing, transportation, and agriculture rises across the board. The Federal Reserve simply cannot cut interest rates if energy-driven inflation is surging back into the economy.
We actually saw the bond market reacting to that exact fear today. I was looking at the Treasury yields, and the dynamic completely inverted from what you would normally expect during a geopolitical crisis.
It did, and it's a vital connection to make. Typically, when a major military conflict breaks out, you see a flight to safety. Investors sell riskier assets like stocks and park their capital in U.S. Treasuries, which are considered the ultimate safe haven. When demand for treasuries goes up, the interest rate the government pays on that debt goes down.
But today, the 10-year Treasury yield actually rose. It hit 4.04%. Why would the yield go up during a war? Shouldn't everyone be buying bonds for safety?
They would be if they weren't terrified of inflation. The fear of inflation overpowered the desire for a geopolitical safe haven today. Bond traders looked at surging oil prices and realized that if inflation returns, the Federal Reserve will have to keep interest rates higher for longer.
So they changed their rate cut bets.
Yes. Swaps traders actually scaled back their bets on rate cuts this year, dropping their expectations from 60 basis points down to 56 basis points.
Just to clarify for the listener, a basis point is 0.01%. So moving from 60 basis points of expected cuts down to 56 means traders are slowly unwinding the expectation that the Fed is going to be able to significantly lower rates this year.
Correct. As one strategist noted in our sources, the traditional bond as haven trade is failing right now because the inflation threat makes locking your money up in a fixed yield asset incredibly unattractive.
That is a brutal realization for anyone relying on the traditional 60-40 portfolio of stocks and bonds to protect them. But within the stock market itself, the reallocation of capital today was fascinating to watch. It was a very stark, logical division of winners and losers.
Very logical.
Unsurprisingly, energy and defense stocks soared. Exxon popped. The defense ETFs like ITA and XAR found heavy buyers. Lockheed Martin caught a massive bid. But on the flip side, the travel sector just got decimated.
It is a ruthless mechanical repricing of operational risk. When you factor in fuel risk and disruption risk, the math changes instantly for travel companies. Cruise lines were incredibly weak. Carnival, ticker CCL, was down over 7.4% intraday. Airlines like Delta dropped heavily too.
I would imagine that for an airline, jet fuel is arguably their single largest operating expense. Even if they have some fuel hedges in place, a sudden 8% jump in crude oil threatens their profit margins for the entire quarter.
Precisely. Money flows out of fuel-dependent, consumer-facing sectors and rotates directly into the companies that either pull the fuel out of the ground or build the defense infrastructure. It is a textbook market rotation.
Okay, so traditional fiat currencies are threatened by inflation, bonds are failing as a safe haven, and equities are hyper-focused on sector-specific rotations. This leads us to a space that has always claimed it would be the ultimate hedge against this exact kind of global chaos, the cryptocurrency market. If equities were a lesson in bouncing off technical support, Bitcoin's weekend chart was a wild roller coaster that ended up proving a major point for its advocates. Let's trace the timeline of what happened over the weekend.
The weekend price action in digital assets was arguably the purest reflection of sentiment because, unlike the stock market, crypto trades 2047. When the attacks in the Middle East began early Saturday, the bottom essentially fell out of the crypto market.
It dropped hard.
It did. Bitcoin crashed below $64,000, hitting around $63,255. Ethereum took a 10% tumble, dropping sharply as well. But by Monday afternoon, the landscape looked completely different. Bitcoin surged right back up, crossing over $69,000, and Ethereum recovered to trade back above $2,000.
I have to ask, if Bitcoin is supposed to be digital gold and a safe haven, why did it crash in the first place on Saturday morning? Shouldn't it have spiked the moment the news broke?
It is a great question, and it highlights the internal dynamics of the crypto market. While the long-term thesis for Bitcoin might be as a store of value, the short-term trading environment is heavily populated by leveraged traders and speculative capital.
Ah, the leverage.
Exactly. When a massive geopolitical shock hits unexpectedly on a Saturday, there is an immediate scramble for liquidity. The traders who were highly leveraged on margin get liquidated, and the short-term speculators, often referred to as paper hands, they panic and sell. That creates the initial violent leg down.
So the initial drop isn't necessarily a rejection of Bitcoin's value. It's a mechanical unwinding of leverage. People are forced to sell to cover positions elsewhere, or they just panic. But then what happened on Monday? How did it completely reverse?
Once that weak leverage was flushed out of the system, the fundamental narrative shifted. We have a great insight in our sources from David Morrison, a senior market analyst at Trade Nation.
What was his read on it?
He pointed out that Bitcoin's behavior during this specific crisis renewed the digital gold narrative. For a long time, Bitcoin has traded almost like a high beta tech asset, meaning it just moves in the same direction as the Nasdaq, but with more extreme swings. But this weekend, in the face of intense geopolitical stress and inflation fears, it behaved less like a risky tech stock and more like a resilient store of value.
Sean Farrell, the head of digital assets at Fundstrat, framed this perfectly in the notes we have. He said that crypto's resilience in the face of geopolitical escalation is constructive, and it suggests room for tactical upside as defensive positioning unwinds.
To unpack Farrell's point, when the initial panic subsides, investors realize they still need a place to put their capital. If bonds are dropping because of inflation fears and equities are flat, capital starts flowing back into the assets that absorbed the shock and showed strength. Bitcoin passed that stress test this weekend.
You can really see that confidence bleeding over into the traditional equity markets today, too. If you look at the crypto stock heat map, the companies tethered to that ecosystem had a phenomenal day.
They really did.
MicroStrategy, which holds a massive treasury of Bitcoin on its corporate balance sheet, was up almost 7%. Coinbase was up roughly 4%. It really reinforces the lesson we discussed earlier. These markets have deep pools of liquidity waiting to buy. When prices disconnect from long-term fundamentals, due to short-term fear.
Market structure is vital. Whether it is the S&P 500 stubbornly holding that 6,800 line or Bitcoin bouncing hard off 63,000, you are seeing institutional and high-conviction buyers stepping in to absorb the panic selling.
Now, I want to transition from the public markets to a story that was unfolding behind the scenes this weekend, because it is arguably the most consequential development for the future of the technology sector. While the financial markets were processing the threat of war and inflation, a high-stakes standoff was taking place between the tech sector and the United States government.
Yes.
We were talking about OpenAI, Anthropic, and the Pentagon. The sheer speed at which this developed is staggering. Let's lay out the foundation of what happened.
We need to look precisely at the stated positions of all the parties involved here, as the implications for government contracting and the tech industry are profound. According to our sources, the Pentagon approached Anthropic, which is widely recognized as one of the leading artificial intelligence companies in the world.
Right.
The Department of Defense demanded the use of Anthropic's AI models for all lawful purposes.
And Anthropic essentially said no. Why would a company turn down what I assume would be an incredibly lucrative defense contract?
Anthropic's CEO, Dario Amodei, refused the Pentagon's blanket request by establishing two very specific red lines regarding how his company's technology could be utilized. First, he stated the models cannot be used for the mass surveillance of U.S. citizens.
Okay, that's one.
Second, he mandated that they cannot be used to develop fully autonomous weapons. He maintained that he could not accede to the Department of Defense's request without those explicit guardrails in place.
It's a very firm ethical stance on how generative AI should be deployed in a military context. But the Pentagon did not agree with those conditions. We have the direct quotes from the Chief Pentagon spokesperson, Sean Parnell, and his response was incredibly direct.
What do you say?
He countered on X, stating that the Department of Defense has absolutely no interest in using AI to conduct illegal mass surveillance on Americans, nor do they want to use AI to develop autonomous weapons that operate without human involvement.
Parnell's framing of the refusal is key here. He called the assumptions a fake narrative and stated unequivocally that the DoD will not let any company dictate the terms regarding how they make operational decisions. To force the issue, the Pentagon gave Anthropic a strict Friday, 5:01 p.m. deadline to comply with the request.
When a deadline like that comes from the Pentagon and you miss it, the political consequences are immediate. And we saw the response directly from the Trump administration. President Trump took to Truth Social to respond to Anthropic's refusal. He posted exactly this: "We don't need it, we don't want it, and will not do business with them again."
A very clear directive.
But it wasn't just a social media post. The administration brought the full weight of federal procurement law into the picture, threatening to invoke the Defense Production Act.
The invocation of the Defense Production Act is a significant escalation. For historical context, the Defense Production Act grants the president broad authority to direct domestic industries to prioritize government contracts for the sake of national security. But the administration went even further, threatening to officially label Anthropic as supply chain risk.
I want to focus on that specific term, supply chain risk. What does that actually mean for a private software company? Because it sounds like more than just losing one contract.
Labeling a company a supply chain risk is essentially the nuclear option in government procurement. If the federal government designates Anthropic as a risk to the supply chain, it effectively forces every single vendor, contractor, or partner that works with the Pentagon to sever all ties with Anthropic.
So they get completely frozen out.
Completely. It would isolate them from the entire military-industrial complex and potentially from broader federal civilian agencies as well.
It is a total exile from the government sector. So Anthropic takes a stand, gets effectively banned, and leaves a massive vacuum for a defense AI contract. And this is where the speed of Silicon Valley business is just breathtaking. Within hours of that Friday deadline passing, and coinciding directly with the geopolitical chaos erupting in the Middle East over the weekend, OpenAI swooped in.
The timing cannot be overstated. To negotiate, finalize, and announce a deployment agreement for classified government networks within a 48-hour weekend window requires an immense level of prior positioning. Over the weekend, OpenAI secured a deal with the Pentagon to deploy their models in classified networks.
How does OpenAI justify taking the contract that Anthropic just turned down over concerns regarding autonomous weapons and surveillance? Did they just ignore those concerns, or did they negotiate different terms?
OpenAI CEO Sam Altman addressed this directly. In their public press release, OpenAI stated that they actually share Anthropic's red lines. Yes. The statement read, and I quote, We think our agreement has more guardrails than any previous agreement for classified AI deployments, including Anthropic's. Altman maintains that OpenAI has strict prohibitions on autonomous weapons where AI is not kept in the loop, alongside existing legal protections against surveillance.
This is a remarkable corporate pivot. Anthropic takes the public hit, gets ostracized by the administration for drawing a line in the sand, and OpenAI steps into the void instantly, claiming they secured the exact same safety provisions that Anthropic was just denied.
The objective outcome is that OpenAI's models are now fully integrated into the Department of Defense's classified networks during an active global conflict.
If we step back and analyze this structurally, it fundamentally shifts how we view generative AI. The government's willingness to engage in such high-stakes brinkmanship with Anthropic and OpenAI's eagerness to rapidly fulfill that demand proves that these AI models are no longer viewed merely as enterprise productivity tools or chatbots.
No, they are now classified as critical defense infrastructure.
Which brings us perfectly to the physical reality of that infrastructure. You can't have a conversation about the AI landscape or AI defense contracts without talking about the hardware that powers it all. OpenAI can sign all the software contracts they want with the Pentagon, but Nvidia is the company out here fundamentally rewiring the physical infrastructure of the internet to make it work. Let's look at Nvidia's big Monday pivot.
This was a massive announcement.
Amidst all the market chaos, they announced a $4 billion investment, splitting it evenly $2 billion each into two photonics companies, Coherent and Lumentum. And the market rewarded the move immediately. Coherent jumped about 8%, and Lumentum surged over 7%.
To understand why a semiconductor giant like Nvidia is pouring $4 billion into photonics companies, we have to talk about the physical limitations of artificial intelligence. As these AI models grow exponentially larger, requiring massive amounts of data to be processed simultaneously, the bottleneck in a data center is no longer just the computational power of the GPU itself.
What is the bottleneck then?
It's the network. It is how fast data can move between tens of thousands of GPUs working in tandem.
And historically, we've connected everything with copper wire, right? What is the problem with copper in an AI data center?
Copper wire creates significant resistance. When you push massive amounts of data through copper at high speeds, it generates a tremendous amount of heat, it consumes huge amounts of power just to push the signal, and it has severe physical speed limitations over distance.
Enter silicon photonics.
Exactly. Silicon photonics solves this by using lasers and optical networking to transmit data via pulses of light. Light travels faster, handles vastly more bandwidth, and generates virtually no heat during transmission. It is vastly more energy efficient and scalable.
Nvidia's CEO, Jensen Huang, provided a quote in the press release that I think perfectly encapsulates their vision. He said, "Computing has fundamentally changed. The age of AI, software runs on intelligence with tokens generated in real time by AI factories for every interaction and every context." I want to stop on two phrases there. First, he mentions tokens. What does he mean by tokens being generated in real time?
A token is the fundamental unit of data that a large language model processes. You can think of it roughly as a word or a piece of a word. When you ask an AI a question, it doesn't process the sentence as a single thought. It breaks it down into tokens, analyzes the statistical probability of what token should come next, and generates the response token by token.
So when Huang talks about generating tokens in real time for every interaction,
he is describing a future where every digital interface we use is powered by continuous real-time AI processing, which requires an unimaginable amount of computing power.
and that leads to the second phrase, AI factories. He doesn't call them data centers anymore. He views them as manufacturing plants. They aren't just storing our photos or hosting websites. They are actively manufacturing intelligence. And to run a factory at that unprecedented scale, he knows Nvidia needs this next-generation silicon photonics.
They absolutely need it, and they have the capital to ensure they get it. If you look at the context provided by their latest earnings report, the demand for this hardware is staggering. Nvidia recently reported a record $62.3 billion in data center revenue. But the most revealing metric within that report is who is doing the buying.
Who is it?
Over 50% of that data center revenue is now coming from a very small group of companies known as the hyperscalers.
These are the massive cloud infrastructure providers, right? Microsoft, Amazon, Meta.
Correct. These hyperscalers are currently engaged in a massive CapEx arms race. They are spending hundreds of billions of dollars building out the physical infrastructure required to host and train the models developed by companies like OpenAI.
So Nvidia's investment in Coherent and Lumentum is basically an ecosystem play. They're looking down the road, seeing that the hyperscalers are going to buy millions of GPUs, and they realize they need to secure the optical networking supply chain right now so it doesn't become the choke point that slows down their own sales later.
Exactly. It is a brilliant defensive maneuver to protect their future revenue growth. And it highlights a stark bifurcation in the technology sector right now, because while Nvidia and OpenAI are dealing in multi-billion-dollar defense contracts and rewiring global infrastructure, we also had Apple quietly drop some new hardware today.
That's true. Amidst the macro chaos, the Middle East war, the oil spike, and the Pentagon drama, Apple announced a $599 entry-level smartphone, the iPhone 17e, along with some new iPad Airs. It feels almost quaint by comparison. Why drop a budget-friendly phone on a day like today?
It is a strategic move to grab market share at the lower end of the consumer spectrum ahead of a major event they have scheduled for March 4th. But it perfectly illustrates the divide I just mentioned. You have the enterprise and defense side of tech, which is entirely consumed by the AI infrastructure boom and national security contracts. And then you have the consumer side of tech. Companies like Apple are having to tweak price points and introduce cheaper models to maintain their installed user base in a challenging global economy where inflation is still a very real threat to the average consumer.
It's a tale of two economies. The hyperscalers are spending billions without blinking, and the consumer is trying to figure out if they can afford a $600 phone while gas goes back up to $3 a gallon. We have covered an immense amount of ground today, pulling from a really diverse stack of sources. How do we bring all this together? What is the grand synthesis of this Monday trading session?
If there is a single unifying thread running through every topic we discussed today, from the broader equities market to energy, crypto, and Silicon Valley, it is the triumph of structural market mechanics over emotional panic. We saw it clearly in the VIX spike this morning, which was methodically crushed as the S&P 500 found its technical support level.
We definitely saw it in the sector rotations.
Right. We saw it in the logical, emotionless reallocation of capital away from fuel-dependent travel stocks and into energy and defense names as oil flows through the Strait of Hormuz were threatened. We saw it in the crypto market, where Bitcoin shed its leveraged speculative traders over the weekend, only to prove its resilience as a digital store of value when the institutional capital stepped back in.
And we saw it in the corporate pivots, too.
Exactly. Whether it was OpenAI maneuvering to secure defense contracts within hours of Anthropic's ban, or Nvidia aggressively securing its photonics supply chain, the data and the mechanics drove the day. Sentimentality took a backseat.
I think that is the ultimate takeaway for you, listening to this deep dive. When the weekend headlines are screaming that the sky is falling and a historic crash is imminent, you have to look at the tape. You have to separate the geopolitical noise from the financial reality. The actual data, whether that is tracking hyperscaler capital expenditure, monitoring the physical flow of natural gas and oil, or watching the S&P 500 stubbornly bounce off that 6,800 channel that tells the real story of the world. Reacting emotionally to headlines will almost always cost you money. Waiting for the data to settle will give you clarity.
It is an invaluable lesson in market discipline, but as we synthesize these events, it also raises a much larger structural question for the future, particularly regarding the events between the tech sector and the government. We watched Anthropic get banned by the administration over ethical boundaries, and we watched OpenAI step in to supply the Pentagon mere hours later.
It really makes you wonder about the intersection of technology and state power. With Silicon Valley's computing power now being rapidly deployed into classified military networks during an active global conflict, are we entering a new era where a generative AI model is considered just as crucial to national security as traditional munitions, fighter jets, and defense contractors?
Yeah.
Think about the implications of that as you watch the tech sector evolve this year. It is no longer just about software, it's about global defense. As always, keep questioning the headlines, keep digging into the data, and we will catch you on the next deep dive.